We've got a decent list of companies to talk about this morning. Let's go to Diane King Hall in New York. Got some upgrades, got some earnings. One that I guess kind of took me as a surprise to some extent, Diane. Well, here let's talk the commentary first on banks actually, because we heard from our guests at the top of the show they like banks. So let's go there for a second. Couple notes out. Are the analysts talking about this as maybe like a way to thread the needle on some of this geopolitical stuff?
Well, it's more about where they are now. You know, the risk-reward ratio looks better now for the banks. And we had heard more analysts at the beginning of this year become constructive on the banks, but we've seen some, pullback recently. So this is Baird upgrading its view on both Bank of America and JPMorgan Chase. Bank of America more so than JPMorgan Chase. Baird boosting its view on B of A to outperform from neutral. Their price target now is 50. Up from 45. That was the price target they had previously. What Baird is seeing now, they're calling Bank of America, quote, great franchise at a reasonable price. They're citing Bank of America's best-in-class deposit franchise, consistent execution. This is a, quote, relatively low credit risk and top-tier markets businesses. So they really like what Bank of America is, where it is now, and they feel like the reward finally kind of outweighs the downside risk that we've been seeing within the banks. In terms of market reaction this morning, not seeing a lot right now of movement. Bank of America up by about 0.75% right now. In terms of the view on JPMorgan Chase, they've upgraded it to neutral, though. That's from underperformed. They've got a price target of 220. That's up from their previous price target of 215. For JPMorgan Chase, they, just talked about the reason they're not as constructive on JPMorgan Chase as B of A is just given where it is now. Even though they're, kind of seen as best in class, they still think that where the shares are for JPMorgan Chase essentially just trade at too high of a valuation. Even though they are off over the last month, they're down, they had been down double digits, but they said they're having a tough time making the short case in that name, even despite the recent weakness there. So they're still watching that. And they aren't necessarily buyers. As I mentioned, they're neutral. But they said it also doesn't make sense to be short JPMorgan Chase. There you go.
Yeah, that chart doesn't look like a real short play, just from the higher highs, higher lows. I like the commentary about some of the valuations in there, too, kind of echoing to some extent what we heard from Chip Rui on banks is, I think a lot of people have had this view that their bar is still pretty low compared to, some of the valuations in other places. All right, let's talk that gap move, up 13%. Yeah. Nice timing for a decent report, I guess, for a company whose shares were at one-year lows.
It is, and this was the one that surprised me as well in terms of its performance, especially in the retail sector. So they beat across the board, whether we're talking about revenue or adjusted EPS. Comps were good as well. Adjusted EPS was 54 cents a share. Street was looking for 36 cents. Revenue, $4.1 billion. Comps were up across the board. Overall comps up 3%. Old Navy also up 3%. We generally are used to and expect Old Navy to perform well. That's been, kind of its outperformer for years now. But its namesake, Gap, did really well, up 7%. And even Banana Republic, you saw that increase 4%. Athleta did lose some ground. You saw comps there down 2%. I wonder if some of that also has to do with the return to office. People don't need the athleisure as much as they used to. But regardless, you're seeing this outperformance in general across the board really helps. It just leads some credence to CEO Richard Dixon being brought back in. He was brought back in to do for Gap what he did for Mattel with Barbie and all of that, and it shows that they're executing well. Now, in terms of their guidance, they did issue some conservative guidance for the first quarter, projecting to be flat to up 1%, and then for the year projecting between 1 and 2%. So a little bit on the conservative side, the CFO saying that we've been operating, quote, in a highly dynamic backdrop for the last few years. We're expecting the same for fiscal 2025. They did account for tariffs within their guidance, but they really don't have a significant exposure when it comes to China and the other places that where we're seeing the tariffs, Mexico, et cetera. So, they don't have a lot of exposure there. They, mentioned it's really, 1 to 10% of where they've talked about this in other media interviews, where their exposure is.
Okay. Seems like a surprise comeback, and maybe, who knows, the sign perhaps that they've figured out how to make their namesake brand, bring people in. Possibly, it feels like one quarter not enough to turn around years of falling behind.
It's true, but Ginny and I were talking about this earlier. You wonder if they may end up having a similar story to Abercrombie and what Fran Horowitz did for Abercrombie. Obviously, Abercrombie's recent quarter and the guidance wasn't what it had been, and so that may be, kind of maturing, or they need to do some revamping of their strategy there. But it will be interesting to see a year from now if Gap has a similar story to what we saw with Abercrombie.
Okay, good stuff. Thanks, Diane. Appreciate the look there at Gap's comeback. Also in the consumer realm, Walgreens up 8%. So there are some movers here this morning. Thanks, Diane, for taking us through the big ones.